Hello everyone, this is Kathy Lean with our class on how to predict economic data better than Wall Street pros. This is one of my favorite sessions because it is my area of specialty and something that we rely pretty heavily on when we try to decide how we want to put on trades. And I think this goes a long way in basically illustrating my line of thought, and it's a very key component of my day-to-day analysis because while when we touched on this a little bit, while the broad fundamental theme, the macro, is very important in setting the general direction and tone of where the currency pair may be headed on a daily, weekly, monthly basis. Economic data is what causes a lot of the intraday price action that can turn into an overall day change or a multi-day change. So to begin, I'd like to share with you this disclaimer. I know many of you are watching this video on demand, so I encourage you to pause this screen, read through this disclaimer thoroughly before moving forward. So why is economic data so important? The reason why it's so important is because news moves currencies, just as it moves equities. We all know that when U.S. non-farm payrolls comes out the first Friday of every month, we'll have first of all, it's a very big focus for the market as a whole, regardless of whether it's the Forex market or the Forex market or the bond market or the stock market. It impacts into focus of all market participants. It will move the S&P almost as dramatically as it will move the U.S. dollar, particularly since currencies are generally traded on leverage by FX traders, although we all know that leverage is a double-edged sword. It can magnify profits as well as magnify losses. But news is important because it really does move currencies and equities, and it really can play a very big role on how currencies and equities trade. So there are two ways to trade news, proactively and reactively. Our focus today is on proactive news trading, but I will share with you one strategy for reactive news trading. And then in a later session, we'll have the opportunity to go over more ways to trade news on a reactive basis. But in order to trade news, it's important to first understand what is tradable. What are the top 10 most market-moving pieces of economic data? And I think in the order of importance, it is the following. Central bank meetings, that's basically, hands down, probably the most market-moving event risk, particularly if they may change interest rates or monetary policy. Central bank minutes can also be very important. Employment reports are significant because jobs are the backbone of every economy, just as consumer spending is such the key component of GDP growth, which is something that we touched on in our first session. ISM and PMI reports, they basically measure manufacturing and service sector activity. Confidence is very important. Housing data is a little less important, but can sometimes be traded. Inflation data, GDP, and trade. But for the most part, what we really focus on in terms of trading is the top 5. Sometimes it'll be the top 6, but the rest of it these days cannot be important. GDP, the first release, is important. The second or third release is less important. So what is proactive trading all about? Well, proactive trading is basically about being ahead of the game. And it's trying to handicap the data and putting yourself in a position where you're laying on a trade before the data is released. The benefits of that is, first and foremost, it's lower risk because, generally speaking, when you put on a trade before the data is released, the stop is pretty clear because generally speaking, the currency pair will probably be trading in a relatively confined range. So the trading range where you should be putting your stop is probably relatively clear. The second is that there's instant gratification. And that means that if you're right, usually your profit target is hit relatively quickly. If you're wrong, then you're usually stopped out relatively quickly. The disadvantage of proactive trading is that it's difficult. It's difficult to predict economic data, which is why many people turn to reactive trading. But in this session, I hope to teach you some ways to predict the data better than Wall Street pros and to basically give you the confidence to trade proactively, to take a quote-unquote educated guess. Now, in terms of news, there's generally two types of information out there. One is scheduled data, and scheduled data is just things that you can get on the economic calendar, on any and all of the most popular forex calendars, and they're basically things that we know are going to happen in advance, and they are economic news releases, central bank meetings, G7, G20 meetings, auctions, big events like the December 4th Italian referendum, the Sun's, as well as other events, that we know this happened. For example, we knew that November 8th was the U.S. presidential election. Those are things that are scheduled data. Unscheduled data or event risks are things that such as geopolitical risks like conflicts and riots, which we cannot anticipate. Comments from central bankers, sometimes that's known when Janet Yellen delivers her semi-annual testimony on the economy and monetary policy. We know that's happening. We know when it's happening. We know when to watch the wires for her comments. But other things could come up unexpectedly. The Europeans are oftentimes guilty of making unexpected comments. Also the Japanese. M&A fixing activity. In our first session, we talked about how fixing can have a significant impact, and of course, upgrades and downgrades from rating agencies. And the best free schedule data website, in my opinion, is Forex Factory. I like DailyFX and Forex Factory. DailyFX, I think, is the most comprehensive in terms of listing what is coming out, as well as providing the accurate forecast, as well as the previous for you to have a reference point. But the fastest to update in terms of getting the number out there as soon as it's released is going to be Forex Factory. The best website for unscheduled data, or the best place for unscheduled data, first of all, the best place for it is Bloomberg or Reuters. But I pay more than $2,000 a month for my Bloomberg terminal. I highly doubt that you want to do that. So you can actually get a lot of this unscheduled information for free these days. Not from me, Kathy Lean FX, because I don't tweet that often, but you can see who I follow on Twitter. I think if you want to be a serious FX trader, it is essential for you to be on Twitter, to be following some of the key sources of real instant news, because whenever there's a breaking headline, either scheduled or unscheduled, a piece of data or a comment from a policymaker, it's on Twitter in an instant. So what are the best resources? Free daily color and analysis on Twitter. These are the people that I like the most, that I recommend the most. And I apologize, there's actually one missing here, so I'm actually going to drop this in right now because it's actually at the top of the list. And it should actually be at Forex Live. For our industry, Forex, they are probably the best. Reuters is really good. Zero Hedge is really good. I like the comments from F. Goria, DJFX Trader. Doesn't update as much as they used to, but if they do, I think it's kind of interesting as well. But Forex Live, Zero Hedge are actually hands down my favorite. So with all that in mind, with all those tools on hand, let's move into talking about proactive trading. So why should you even bother predicting economic data? Well, I feel that, by predicting economic data, what you're essentially doing is that you're giving yourself a leg up in the market. You're basically giving yourself, if, for example, you see the chart setting up for a potential buy in the pound dollar, and you think, based upon some of the things that you looked at, that tomorrow's UK employment report is going to be good, then you may have the fusion of fundamentals and technicals to give you confidence to take a proactive trade. And the benefits of predicting data is that you could realistically have a proactive trading opportunity. It can also, and probably more importantly, help you avoid potentially bad trades. Because, for example, if, let's say, you are happily shorting the euro dollar, and you're selling it, and you're thinking, okay, I have the German IFO report scheduled for release tomorrow. So let's say you have a German IFO report scheduled for release tomorrow, and some of the things that you look at suggest to you that the data could actually be kind of good. So if it suggests to you that data could be actually be kind of good, perhaps you want to get out of that trade. Perhaps you want to get out of that trade given the possibility of the number going against you. So it helps to predict economic data because aside from providing you with a trading opportunity, it can also help you avoid potentially bad trades. Now, to start, the key to trading proactively is we focus on pure event risk, and we understand what's tier 1 versus tier 2 data. So basically, data that is significant versus data that is not significant. So in terms of data, I think it's important to understand that when it comes to, and for those of you that have been trading for a while, you may know that data from Japan and Switzerland rarely moves currencies. More often than not, it will have nearly zero impact on the currency, or very limited impact on the currency. And so we don't think it's worthwhile to trade Japanese or Swiss data. Sometimes we have a major BOJ meeting where they are expected to take some type of action, then that could be completely different. But generally speaking, if it's just kind of, even GDP or miscellaneous things like that, I think that it's better to just avoid trading Japanese or Swiss data most certainly, because Swiss data, in my opinion, doesn't have any significant impact on the currency. So what else do we avoid trading proactively? We generally avoid trading non-farm payrolls, central bank rate decisions, and anything without forecast. We love to trade those things reactively. And I'll show you one way to do that later. But we certainly avoid trading those proactively because they can be very erratic. And with non-farm payrolls, there's so many things like average hourly earnings, the unemployment rate that can dilute the significance of the headline number. With central bank rate decisions, it can take them a while to speak, to make their point, and to take the Q&A session. So it's not as if we're one and done and the number comes out and we're done with it and we're good. So it's much better to basically wait for those releases to come out, and of course anything without forecast because it's not handicapable, and then take the trade. What we do love to trade proactively are things like retail sales, inflation numbers, employment numbers, PMIs, confidence numbers. Those things are all very, very much tradable. So how do we do this? How do we predict economic data? Well, in my experience, in my opinion, it's actually quite simple. What we do is we look for clues. And so how do we look for these clues? Well, if you think about it, or maybe you don't really know of it offhand, but I'll share with you. There's a lot of things that basically are very much related. For example, if you think about it, consumer prices are very much correlated to producer prices. That should be fairly logical. That should make sense to you because they both reflect inflationary pressures. Another example is there's definitely a correlation between the manufacturing activity indexes, the ISM and PMIs, with the service activity indexes, because that's also a reflection of general economic activity. So, all that, the correlation in all of that should make sense in our opinion. So what I'll do is first I'll kind of walk you through the process of predicting economic data proactively. And then I have some cheat sheets that I'm going to go through with you and provide to you so that you can have a kind of guide to learn how to do this yourself on a day-to-day basis. So let's start with Australian employment. So let's say, this given day we had, this was I think one of the more recent Australian employment reports, we had Australian employment numbers released, and the market is looking for a stronger number. But our forecast is for a weaker number. So we're actually going against what Wall Street experts are saying. So you may ask, what makes you think that you can predict economic data better than a Wall Street pro, better than those high-paid economists who are sitting on their ivory towers? Not so much on Wall Street these days. They actually sit in Midtown because after 9/11, a lot of the major banks moved their headquarters out to Midtown and closer to Grand Central. But anyway, why do you think you can predict economic data better than them? It's not so much what we can do, but it's more the freedom of what we can do. Because what a lot of these banks have to do is that in order to predict economic data effectively, they've got to have models, and these models have to basically take into account very sophisticated things, such as how much job is from one sector of the economy versus another sector of the economy that's being created. What are the labor market trends in this part of the nation and things like that. So it's very sophisticated, and it needs to be justified in a logical way to their higher ups. Whereas all we do is we kind of use other labor market indicators that's been released, and we just pick direction, because what they have to do is that they have to use these models to come up with a specific number for their forecast. It's not as if they just pull the number out of a hat and say, I think 15,000 jobs are going to be created this month. They basically have to come up with a model explaining where this 15,000 comes from, which is a lot more difficult than what we do, which is basically predict the directional surprise. So with all that in mind, our job is easier, and we have less accountability because we don't have to predict a specific number. We're just predicting a directional surprise. So Australian employment. Let's try to figure out what Australian employment will be like. What are the clues? Well, my favorite leading indicators are hands down the PMIs. The PMIs basically provide us with a wealth of information. They provide us with so much tremendous information because the PMIs have a lot of breakdowns. The breakdowns include prices, exports, employment, a whole bunch of miscellaneous things, and even sometimes retail sales that can give us some insight into how other reports will fare. So with Australian employment, they recently changed their methodology for tabulating employment numbers. So it can be relatively volatile, but basically the PMIs in general for any country provide the quote-unquote fastest or most recent reflection of how an economy is doing. So they provide the most recent reflection of how an economy is doing, whereas the labor market report is usually 1 or 2 months back. So generally speaking, with employment numbers, we basically look 2 months back. So in this report, we had an upcoming Australian employment numbers. We look 2 months back, and we see that, so this was for, I think, the October Australian employment report. So it's for the October Australian employment report, and we see 1 month back is September is 46.7, 2 months back is 44.6. So we see that in this period here, between July and August, this is the employment component of manufacturing PMI, we had a huge drop in employment. Basically, employment dropped from 56.5 to 44.6. So that tells us that in the manufacturing sector, we're going to see a subtraction of jobs for that month. Same thing, we'll look at the August reading. We see that in August, we also see that employment fell sharply in the services sector. Let me see if I can get my spotlight showing you. This is the Australia's Performances of Services Index. In the service sector, we also see that. And we see that, we also see that the index, let me get my spotlight, went from 50 to 43.5. And let me go to the next one. And then lastly, the construction sector. This is Australia's September Performance of Construction Index. The employment component also went from 52.2 to 47.6. So basically, the manufacturing, service, and construction sectors all experienced weaker job growth. So even though these ivory tower economists, believe that job growth basically accelerated, our leading indicators tell us that job growth slowed. So what's the trade? So given that our leading indicators tell us the job growth slowed, this is the way we apply our trade. The whole rule of thumb is you want to enter the trade 20 minutes before the news release. 20 minutes is the sweet spot because one of the dangers of news trading, particularly proactively, is that spreads can widen. They can widen quite significantly. And so, they can widen quite significantly, and there can also be, a lot of focus beyond, what the market is watching. So with the proactive trading, 20 minutes is sweet spot because it's long enough where the spreads are still relatively narrow, and it's short enough that the market is very much focused on that piece of economic data. So that's why we like putting on the trade 20 minutes before the release. So here we enter in the trade 20 minutes before the release, and we can see we enter in the 20 minutes before the release, and that's where my arrow is pointing. And you can see right before that, we have very nice kind of quiet consolidation. The currency pair making stops, pretty clearly defined. And you place your stop about 25 to 30 pips away from your entry point. So in this case, we enter 20 minutes before the data, pretty much 77.25, I would say. Your stop, even if it's at 40, you wouldn't have been stopped out. It did rally a little bit before, it moved lower. Number comes out, and it's horrid. The employment change came out at minus 9.8 thousand. And what was even worse than that was that full-time employment basically dropped 53,000. So pretty horrendous number on that front. And it was a pretty horrendous number, even though the unemployment rate basically improved to 5.6%. The participation rate held steady, actually deteriorated. So everything was worse except for the unemployment rate. So what you do is, usually with news trading, we don't always get a huge move. So because we don't always get a huge move, then basically what you want to do is you want to close half a trade when it moves by 20 pips, and you move your stop on break even. Although oftentimes I would just recommend going, 1-to-1, because if you go 1-to-1, if you go 1-to-1, you're basically almost, it's a good move, 20 pips. But if it's a really big piece of data, if you move your stop on your second half of the position to break even, you can ride the rest of the move if it goes in your favor. So here we enter 20 minutes before the data is released. So we basically enter at 77.25. We put our stop at 77.35. We close half of the position when it's moved by 20 pips. So we close half of the position when it's moved by 20 pips at, sorry, did I change your view? No, at half the position at 77.05. And then we close the second half, the second half of the position, you moved your stop to break even. At that point, you can trail it by whatever you want. You could trail it by 20 pips. You could go for 2 times risk. So let's say, and I think that's probably the most you can expect, which is that if you risk 20 pips, you might want to go for 40 pips on the second half of the position. So if you went for 40 pips the second half of your position, you can see that shortly thereafter, you close the second half of the position at 76.85. So, pretty fast trade. If you look at this, it looks like from this chart, the whole trade lasted, this is a 5-minute chart, so I would say 5, 10, 15, 20, 25, 30, 35, maybe no more than an hour was how long the trade lasted. So that's an example of the trade. Just give me 1 second. Now, of course, if the data doesn't go your way, then obviously what you want to do is close the trade immediately. If there's any component that is relatively ambiguous, then you want to close the trade immediately. So after you move your stop to break even, you close the rest at 2 times risk. And I already walked you through how we would have closed the trade at 2 times risk. 2 times risk. So, the screens I showed you were my Bloomberg screens. And you may wonder, how in the world can I get this information? Well, it's actually publicly available because let's say we have the Australian, all you do is Google. And in the cheat sheets, I provide you with some links. But I'm just going to pull up my Google screen. We can look at the most recent report. I prepared my slides before the most recent report was released. So let's just say Australian PMI. So it's actually in the first link that comes up. So you don't need to pay $2,000 a month like I do for my Bloomberg screen. So you pull up Australian PMI. And there you go. Manufacturing index, service index, construction index. So all you do is you access the latest report. Actually, you want the report before that. And so I'm sure you can find the report before that. Let's see if we can find. Here, Australian PMI, manufacturing index. And let's see the employment component. Actually, Trading Economics doesn't have it. So I think probably your best bet will be this Australian industry group. And you can probably get the latest reports here and fiddle around for where you can get the other releases. But they basically provide you with a report. I was hoping to find something that's a little easier for you to read. But they do provide you a report, and at the bottom of the screen, they give you like a nice little table that kind of explains what's happened. So in the most recent release, you can see this is manufacturing sector. And they reported that employment in the manufacturing sector improved. So you get this little subcomponent here. Services sector. I'm just going to scroll to the very bottom. Services sector, they also show a big improvement in services employment right here. Service employment 52.9, 8.6 jump. And then construction. Usually services and manufacturing are the most significant. Construction is less significant. If you have services and manufacturing agreeing, then it's good enough. but you want all three agreeing ideally. In this case, construction was slightly weaker. So I would say this would give us not a top tier confidence, but a level 2 confidence. So let's take a look at the most recent Australian employment report, which was this past week. So you can see market was looking for an improvement. There was an improvement, but it wasn't quite good enough, as indicated by the construction PMI report, and see how the trade would have worked out. So it says that it was 1116. The number itself was kind of mixed in the sense that full-time employment was good. The headline wasn't good enough. The unemployment rate did improve. Let's see. I think it was worthwhile to take a proactive trade in this sense. Let's see what the trade would look like. So this is actually 11:16, and this is 7:30. So 5, 10, 15, 20 minutes before the release, you would have gone long at 74.84. Number comes out, it pops higher to 75.01. So it does rise, but not quite good enough. So at that point, because the number wasn't overwhelmingly positive, you probably should have gotten out immediately. And maybe you would have gotten out with a little bit of profit, but I think you most certainly could have gotten out for break even or maybe a little bit of a loss. It wasn't the perfect trade because we didn't have all three leading indicators line up, and meaning construction, manufacturing, and services employment. And that's really what you want to look for. But if you insisted on taking the trade, you maybe could have gotten 10 pips out of it or something. 10 pips is quite easy, generally speaking. So if you want to narrow your profit targets 10 pips, that's a quite easy, achievable post-data move, and probably advisable for those of you that really want to focus on short-term news trading. German unemployment. So this specific month, German unemployment is expected to be weak, and we think, compared to the previous month. So what are the leading indicators? Well, once again, it's going to be the German PMIs. And Market Economics has a really nice German PMI report, and it's all publicly available. And in this report, in the first page, they said the sharp rise in new order volumes encouraged companies to further add to their payroll numbers at the start of the first quarter. The rate of job creation accelerated since September and was the most marked in just over 5 years. So it was the strongest job growth in more than 5 years, which should scream to you that it should be, or it's screaming to you that it should be a strong number. How do you get this report? I mean, it requires a little work because you actually have to, dig these things up. But in my cheat sheets, I include the information. But you just Google. Once again, it'd be Market Economics. It's just marketeconomics.com. I have a direct link, but they basically provide, all their PMIs here. So just view all and just look for German flash PMI. I'm just going to pick a random one here. German services PMI, and you can see that it loads up, and you just read the report. Just for the highlighted words of employment, strongly rising employment. That's basically what you want to look for. It's a little bit of work, but trading, making money requires work. So back to here. The last sentence says the job growth is the strongest in more than 5 years. So enough for us to take a strong, proactive view. And here you go. Unemployment change declines. That's good for the euro because it means that there was a drop in unemployment. And on top of that, we had a drop in the unemployment rate. So our leading indicators led us to believe that there was going to be an improvement in job growth. So how could we have traded this? So 20 minutes before the news is released, we lay on a long trade. So we buy the euro at 110.67 where my arrow is pointing. We go long the euro at 110.67, and our stop is at 20 or 30 pips below. You can see that our stop would have been at 47 because we're entering 20 minutes before the data. The market is very focused on the data. The range is very clear. A move below 47 would be a significant break of this recent consolidation, at least 4-hour consolidation in the euro dollar. So our stop is at 110.47. If you want a little bit more leeway, you can do 30 pips. And our first profit target of 110.87 is hit relatively quickly. And your second profit, considering that in the next, after the number comes out, in the next 5, 10, 15, 20, 25 minutes, the currency runs up all the way to 111. Your first profit target would have been hit. Your second profit target would not have been hit because your second profit target was at 111.07. But if you moved your stop to break even, you would have made money in your first half of the position. Once it started to reverse a little, you probably should have gotten out, like if it drops below 90, and gotten out of your second position at your first entry price. That's kind of more like dynamic trading. More employment reports. We really do like to trade employment reports. The next one I want to review is Canadian employment. Now, Canadian employment is kind of tricky. And the reason why it's tricky is that it's oftentimes released on the same day as U.S. non-farm payrolls. And of course, U.S. non-farm payrolls is probably is certainly more important and more market moving for the loonie or for dollar CAD as a currency pair than Canadian employment, although Canadian employment is also important too. So sometimes CAD employment takes a little time to react, and it reacts first to the U.S. number and then to the Canadian number. So Canadian employment is only really tradable when it is released by itself on the day when there's no U.S. employment released. Also, you want to trade Canadian employment when the IVPMI is released beforehand because that's our leading indicator. So this month, we have the economist, our ivory tower economist looking for an improvement in job growth. So what are we expecting? Well, we take a look at the IVPMI. That's our clue. So the IVPMI for this month, as I said, the PMIs are so valuable. And you can see that they break it down. They show you that the employment dropped. So economists are looking for a stronger number. And I just want to go to my Google to show you where you can get IVPMI. Just Google search. IVPMI. First link that comes up, that's what you want, I hope. And that's what you want here. 57.3 on the very first page. The latest reading is 57.3. The previous reading is 54. I think it's a different month that we're looking at because the latest one, CAD and U.S. employment, came out in the same day. But this is how you would access the information. Publicly available, completely free, just a little bit of work to give yourself a nice edge. So IVPMI this month was weaker. And take a look at this. We did have a stronger number. Oh, I apologize. We have to look 1 month back because IVPMIs come up for the latest month. So we always look 1 month back. So here we look at July. It went from 52.5 to 59.5. So good number. So employment comes out really strongly. And this is the trade where you enter 20 minutes before the data. And the low, we enter 129.58. Stop is at 129.78, and target is at 129.38. And you can see that our first profit target was barely hit because while the number was good, it wasn't quite good enough. CAD employment is kind of tricky to trade proactively. Next example is the PMIs. So the PMIs we love to trade as well. And the PMIs are very much tradable, and there's quite a bit of leading indicators for it. UK PMI manufacturing is a number that we love to trade. So UK manufacturing PMI, this specific month, it came out at, market was expecting a drop from 55.5 to 54.3. So what do we think? Well, in the cheat sheets that I'll go over with you later, the leading indicator for UK PMI is the CBI Industrial Trends, Total Trends Survey. They both are a reflection of orders for the manufacturing sector, and you can see that the CBI data here basically dropped significantly in this latest period. It dropped significantly. It dropped from -5 to -17. So it screams to me that should be a weak number. 20 minutes before the release, 5, 10, 15, 20. My arrow's pointing somewhere. 5, 10, 15, 20. We enter around 122.60s. Our stop is I think we enter around 5, 10, 15, 20. We enter probably around 65, I would say. Our stop is at 85. It does run up a little bit, but then it completely reverses, and you can see the move went from 122.80 all the way down to at least initially move 122.40, but even all the way down to 122.10. So you definitely would have hit your first profit target. And you definitely would have hit your second profit target because you wouldn't have been stopped out at break even. Another one, UK retail sales. The CBIs are really valuable. It came out recently. I want to review it with you. So basically, UK retail sales came out this past on November 17th. The leading indicator for UK retail sales is a number that has the word retail sales in it. So it should be so it should make sense to you that it is a leading indicator. It's called the BRC sales report, the British Retail Consortium's retail sales report. That rose strongly in the month of October from 0.4 to 1.7. So it should scream to you that the proactive trade, the trade to take, is to buy pounds before retail sales. And take a look at this. We had a hugely strong UK retail sales report on November 17th. And let's take a look at the trade. November 17th, data comes out at 4:30. Right here. So we enter 20 minutes, 5, 10, 15, 20. We enter right here, right around 124.65. And, you know, our profit target was hit right before the data was released. And then 65, our second profit target may or may not have been hit because the actual high was 0.5. But you can see how we were right in the data and how the currency pair moved. And the last example I want to show you is a confidence measure, the U.S. University of Michigan Consumer Sentiment Index. Confidence measures can be tradable. These are all very recent examples. So the leading indicator for the confidence report is the IBD Investor Sentiment Index. Both sentiment measures, just like the leading indicator for the Conference Board's consumer confidence measure, is the University of Michigan Consumer Sentiment Index. So even before looking at the actual number, you can see the market was looking for a good number. And this brings up a really good question, is that if the market's already looking for the same direction that I'm looking, should I take the trade? Yes, very much so, because sometimes that's really the best trading opportunity. And you would miss a lot of good trading opportunities if you did not take the trade as the market signaled that even though economists were saying that's a good number. So before that, with the release of the IBD TIPP Economic Optimism Index, you can find this on Forex Factory, Daily FX, and you can see the index rose from 51.3 to 51.4. So that told me that the number was going to be stronger. So it comes out, and it comes out hot, 91.6 instead of 87.9 expected. And here's the trade. We go long 20 minutes before 10 o'clock, 5, 10, 15, 20. We go long at around 106.45, I would say, and data comes out, and dollar yen powers higher, all the way hitting our profit target of 106.65 fairly easily. And in this case, we've gotten the first profit target, and we may or may not have gotten 85. My chart kind of expires here. Pretty much by 3 o'clock, you probably want to be out of this news trade anyway, and just take your close your trade. Do these leading indicators work 100% of the time? No, but they certainly work, in my experience, more than 70% of the time. And the most important thing is that they tell you, they give you an edge in the market. They tell you whether it's worthwhile to take they give you an educated guess, give you the confidence potentially, by looking at some past data, it gives you the confidence to potentially take a trade in that direction, or to avoid a trade. If you want to go short pounds ahead of UK retail sales and you saw the leading indicators that to you is going to be very strong, maybe you shouldn't. Now, many of you may have listened to everything that I've got to say and say, wow, that's really great, Kathy. And I can see this working. I can see this happening. But I can't possibly imagine doing this myself. I just wouldn't know how to get started. And this is just way too difficult for me. And that's where reactive trading comes in. That's where this is your alternative if you don't want to do the homework and take advantage of the proactive trades. Whereas in my experience, I feel like it's just a little bit of work, but if you're not comfortable with it, then I totally understand. So the whole notion with the reactive trading, we do this actually every single day with our members at BK. And, Boris will share with you quite a bit of different ways to do this. But the great advantage about reactive trading is that there's no guessing. And the whole idea with reactive trading is you have to understand that the FX market is huge. Prices do not always adjust instantly. And if the news is important enough, there will be continuation. So what makes reactive trades so compelling? Well, there's no guessing of the data. And you have a limited exposure to market risk in the sense that the numbers already come out. And so the market is very much focused on that number and can react accordingly. So you already eliminated the risk of trying to guess what the data is going to come out like. The key to reactive trading is patience and to be conservative. So the whole idea with reactive trading is you're kind of ambivalent to the actual outcome of the data, because either it's so strong and there's continuation, or it's so strong and there's no continuation and the market doesn't care about the number anymore and it moves on. And by being ambivalent to the data and using this our news time box strategy, you can just trade the market sentiment and its reaction and not necessarily what you think should happen. So basically, you're trading what is happening versus what you think should be happening. And it's quite a simple strategy, in my opinion. What you do is you identify the time box. And the time box to trade is basically, the time box that you want to look at is 5 minutes before the news is released and 15 minutes after the news release. That's the range that you want to define. And the second step is to place a buy order at the high of the range and place a sell order at the low of the range. You probably may want to do 2 or 3 pips beyond that just to give a little bit of wiggle room. And then it's one cancel the other. If one order triggers, then you want to cancel the other order. First, your 20 pip stop, 15 pip first target. You want to be conservative, in and out, because it's already after the news. Sometimes the large part of the reaction has already happened. If one triggers, cancel the other. So here you go. You enter the trade, 20 minutes. This is the same Australian data trade that we had. So in the proactive trade, we entered the trade 20 minutes before the news release where the arrow is pointing. Now I'm going to share my spotlight. So we enter 15 minutes. So we identify the range 15 minutes. So the top of the range is here, 5, 10, 15. The bottom range is right here. So we wait. We wait for either the top of the range to be broken or the bottom of the range to be broken. So here we can see that the bottom of the range is broken right over here. So the bottom range I would say is probably 93 maybe. So let's say you sell 93 and your profit target is 15 pips, so basically 78. So you get triggered over here. It flushes lower, doesn't quite go. It rallies, but it doesn't stop you out, and then it just continues. Maybe you want to go with a 25 pip stop or 20 pip stop, depending upon how much of a move we had before. Now let's take a look at another example and how we would have traded it. Here's another example. This was the Canadian employment report where we kind of got screwed over, where it's it only moved right to our profit target, and we got screwed over because the data didn't, the currency pair didn't react as per the data. But anyway, if we were trading this reactively, this is a news release 5 minutes before. So this is the bottom of the range. This is where you put your sell order. 5, 10, 15. You put your buy order right here. So we put our buy order right here. So that means that we go long a few pips above, maybe 130. This must be like 130.05. And then it gets triggered here. Your stop is 85 or 80, depending upon your comfort level. And then your profit target is 20, and you can see it retraces a little bit, but it doesn't stop you out because your stop is somewhere down here, and then it hits your profit target. Another example, this is the UMich data, where we basically had gone long there. So here's the data release right here, 5, 10, 15. This is the high, and this is the low. In this case, I always like to show winners, losers. You can see that this trade actually would have been stopped out, and that's what stops are for. Oh, this is the pound dollar trade. This is the pound dollar trade. Here, the data actually comes out right over here at 430. This is the top of the range, 5, 10, 15, the bottom of the range. So we sell right here. So we basically sell right here at 50, and stop is somewhere over here at 70, and profit target is at 35, and you can see that it hits 35 and then continues lower. When it comes to news trading, it's important to know what to trade, when to trade. If you, basically between 6 p.m. New York time to 12 a.m. New York time, then during that time period, that's when you can trade. You can trade Australian, New Zealand, and Chinese data. If you can trade between 2 a.m. to 5 p.m., then the currencies and the data to trade is Eurozone data, UK data, and London open opportunities. And then if you trade during the North American hours, 7 a.m. to 12 p.m., then you can pretty much trade any of the major currency pairs, and you're trading U.S. data, Fed speak, U.S. stocks, and the U.S. Market open. This is just one way to trade reactively. We have many ways to trade reactively that Boris will share with you in a future session. So when it comes to trading in general, our process is that we start with the clues. We look for the clues and where the opportunities are. We use the clues to help us establish our views. And then we check the technicals to see if the trade, if we're looking at a, kind of a thematic swing trade, we check to see if the technicals support our view. And that's the way we try to, that's the process that we put into place to try to put together our trades, which is we establish our view, and then we check the charts to make sure they're conducive of it. Because with our trades, we always feel that you want fundamentals, technicals, and sentiment on your side in every single trade. And that's what we try to do with every single trade that we take. So now I want to take a look at the cheat sheets and just kind of run through them with you quickly so you understand what you're going to be getting. So I sent this to myself over Bloomberg. So these cheat sheets will be loaded up right underneath the video when the recording's sent out. And basically, I just closed it by accident. Here. It just shows you the red is the economic release, the black is the leading indicator first. So for non-farm payrolls, the leading indicator is the employment component of non-manufacturing ISM. For the U.S., retail sales leading indicator is the chain store sales report and the Johnson Red Book spending report. So things are very much correlated. ISM manufacturing index, the leading indicators are the 3 regional manufacturing indexes that come out before the ISM manufacturing report. For non-manufacturing ISM, the leading indicator is ISM manufacturing. For consumer prices, the leading indicator is producer prices. So things that should make sense. For personal spending, the leading indicator is retail sales. So these are the things that we have leading indicators for. I've only included the data that we feel is tradable and has reliable leading indicators. So I've kind of done the work for you and listed out all the leading indicators that you should be looking at and that you should be using. For Canada, employment component IVPMI. for retail sales in Australia. It's a sales component of PMI services. And of course, we do not trade Japanese or Swiss data. So we'll be adding this into the post where the video is, right underneath the video. So with that, I'd like to open up the floor to any questions you may have. And as always, if you have questions later on, you can always email us at contact@bk4x.com. I'd be more than happy to answer them. So feel free to type away any questions. Yep, we are going to be sending you the cheat sheets in the email with the recording, as well as posting it in the underneath the video. And this will take me probably, I don't know how long it'll take to render, maybe an hour. So I should have it to you shortly thereafter. I know it's a lot of information to absorb, but hopefully it kind of made a little sense to you and, gave you a little bit of an insight into basically, the way we look at the markets and how we handicap economic data. We don't trade Japanese and Swiss data because with Japanese and Swiss data, it really doesn't move the currency enough. And so we don't think it's valuable to trade. And we don't really see much of a trading opportunity because they just don't move the currency. I am new to Forex. When do we choose yen dollar or dollar yen? Which pair first? Hung, in our first video, we talked about counter versus base currencies, and there's actually a convention. In dollar yen, it's always traded as US dollar first and Japanese yen second. I highly, highly encourage you to watch the first video, which will be in that same recording page that I send to you later on.